If you are into investing, you've surely heard of Warren Buffett. Mr. Buffett is a very successful investor and has a net worth of over $100 billion, which also makes him the world's 7th richest person as of April 2021. His investment record is outstanding, having delivered compounded annual returns of a little over 20% over the last 55 years, which means if you had invested $10,000 in Berkshire Hathaway in 1965 when Buffett took over the company, that $10,000 would today be worth $280 million. Now, over the years, a lot has been written about Buffett's investing style by others. In fact, Buffett himself has eloquently penned down his thinking framework in his annual letters to the shareholders. So in this video, we put together the information that's available into 9 valuable investing lessons, which will help us become better investors. Switch to 2021 and we see many first-time investors trading in stocks and cryptocurrency without really understanding how these works. Buffett has time and again advised investors to not chase everything that shines and to only focus on opportunities that one understands. For instance, Buffett himself did not understand how to value technology companies for a prolonged period of time and stayed away from these for many years. In fact, it was only in 2016 and after really understanding the business that Berkshire Hathaway bought a stake in Apple. But keeping away from technology was not a problem for Buffett at all, and this performance chart of Berkshire Hathaway versus the Nasdaq really proves it, with Berkshire Hathaway staying ahead of the Nasdaq for most of these last 2 decades. The point Buffett makes here is that if you know what you're doing, then there are opportunities everywhere. For someone who earned billions using his stock picking skills, Buffett's advice for retail investors to use low-cost index funds is certainly surprising. But come to look at it, Buffett's endorsement of index funds has clear reasonings behind it. After all, investing via index funds gives you the advantage of a system. It allows for a disciplined investing cycle via SIPs, and it keeps emotions away from corrupting that framework. In other words, Buffett wants retail investors to follow a system over everything else. And it is this system and a clear investing framework of finding great businesses at good, reasonable prices that has powered Berkshire Hathaway for the last 5 decades to become one of the biggest and most profitable corporations in the world. From Buffett's perspective, buying a stock is nothing short of buying a business, and one should follow the same kind of rigorous analysis and due diligence as one would do when buying a business. For example, say I offer to sell you my company for 500 crores. Now you're not likely to pay me 500 crores without wanting to know some details like how much profit is this company of mine generating, what are the competitive advantages, what are the growth prospects, the risks, the capital expenditure required, etc., etc. Buffett's lesson here is that instead of getting too caught up in the recent movement of stock prices, one should spend more time in analyzing the business behind the stock price and invest in a business that one would like to own for the next 10 to 20 years. Case in point is Berkshire Hathaway, which displays an owner's mindset with their multi-decade holdings in companies like Geico, Coca-Cola, American Express, and Wells Fargo, among many others. The stock markets work in cycles of greed and fear. So when there is greed, when there is optimism, people are ready to pay more than what a business is worth. But when fear sets in, then great businesses are available at huge discounts for anyone who's ready to keep their gloomy emotions aside. Warren Buffett is one such person who has perfected this art and encourages other investors to do the same. For instance, when there was the global economic meltdown in 2008, it was fear which was questioning the long-term prosperity of most businesses. Buffett swiftly moved in and made large investments in blue-chip companies like GE, Goldman Sachs, Bank of America, Mars, and Dow Chemicals, which per a 2013 estimate fetched a profit of over $10 billion. In fact, here's what he wrote in his 2018 shareholder letter. Seizing opportunities does not require great intelligence, a degree in economics, or a familiarity with Wall Street jargon such as alpha and beta. What investors need instead is an ability to both disregard mob fears or enthusiasms and to focus on a few simple fundamentals. A willingness to look unimaginative for a sustained period or to even look foolish is also essential. In other words, Buffett encourages investors to not follow the herd and to strip away emotions when making investing decisions, which is likely to open up more profitable opportunities. Besides being funny, Buffett is also very frugal. In fact, it's said that he never spends more than $3.17 on breakfast. Warren Buffett goes by the philosophy, hold on to your money when money is cheap and spend aggressively when money is expensive. This was seen in the year 2000 and again in 2008 when every financial expert was criticizing him for holding on to billions of dollars in cash and not deploying it in stocks. But what they didn't know is that Buffett was saving all that cash to be used when companies come down from the then astronomical valuations to more reasonable prices. Here's the investing lesson on this that Buffett wrote in 2016. Every decade or so, dark clouds will fill the economic skies and they will briefly rain gold. When a downpour of that occurs, it's imperative that we rush outdoors carrying wash tubs and not teaspoons. In other words, when life gives you lemons, don't just make a lemonade, but also make a lemon pie, a lemon jam, a lemon pickle, and sell all the remaining lemons at the bazaar for a big fat profit. For someone who was taught by Benjamin Graham, one would expect Buffett to love a company that is available at a few cents to the dollar. However, after some poor acquisitions and investments he made early on, Buffett came to realize that a cheap business may be cheap but may not be a profitable investment. In fact, when he bought Berkshire Hathaway, it was in the textile business and was valued at a deep discount to its book value. But while operating the business, Buffett realized that the business was a cash guzzler and all the money earned from the business was going back into it as capital expenditure. This experience, and with a lot of guidance from Charlie Munger, Buffett started evolving his investing style from the classical cigar butt value investing approach to one where you look at a business's competitive advantage, intangibles like brand value, cost superiority, and its strong growth prospects. In other words, Buffett found more comfort in buying a great company at a fair price rather than buying a fair company at a great price. Imagine two businesses. The first one, company A, grows by 20% every year and the other one, company B, grows at 10%. When we run compounding on these two businesses, we see that company A would double company B's output by the 8th year and on an accelerated basis become 5 times the size by the 19th year and 10x of B by the 27th year. Warren Buffett understood the importance of time in investing and has reaped the benefits of compounding. In fact, compounding is also visible in how his personal wealth has grown over the years, with him making a lot more money in the last 10 years than what he made in the first 50 years. Buffett extends the time as a friend concept to the businesses he buys by looking at them not over a 1, 2 or a 3-year period, but over the next 20 to 30 years. This learning is particularly important presently when most investors work on a daily, weekly or a few short months horizon and most definitely do not receive any advantages of compounding. If there is one practice that infuriates Warren Buffett, it is that of taking on debt to finance the buying of stocks. In the words of Buffett, when ordinary people borrow money to buy stocks, they are putting their livelihoods in the hands of a market where swings can be random and extremely violent, even when it comes to a reliable stock like Berkshire Hathaway. For instance, over the last 5 decades, Berkshire's shares have suffered 4 major dips. These happened in the 1970s, 80s, 90s and the 2000s, so one every decade. And it happened for a period of 6 to 24 months when at least 1/3 of the company's value was wiped out. It was on this table that Buffett said there is simply no telling how far stocks can fall in a short period. Even if your borrowings are small and your positions aren't immediately threatened by the plunging market, your mind may well become rattled by scary headlines and breathless commentary, and an unsettled mind will not make good decisions. He further adds, "We believe it is insane to risk what you have and need in order to obtain what you don't need." That's why Buffett is a fan of some kinds of debt, just not the kind that can leave consumers broke and helpless, especially when the markets go down. Although this part is coming at the very end of this video, we have seen that everything Warren Buffett does and advises has an element of simplicity to it. Buffett himself follows a simple to understand investing framework which can best be defined as buying stakes in a business where the price one pays is far lower than the value one derives. Of course, this is easier said than done. But the point Buffett continues to drive is that he wants investors to invest in simple and understandable instruments only and use a process that one can easily digest. Which means if you don't understand cryptocurrency, don't invest, trade, speculate in bitcoins. The same goes for futures, options, penny stocks, forex, commodities, silver, and the dozens of new, shiny, and glamorous looking investment vehicles we are exposed to every year. Keep it simple, improve upon what you already know, stay within your comfort zone, and there are enough and more opportunities for one to exploit. And with this, we come to the end of this simple video. As your homework, we'd like to leave you with 3 resources that you can read in your free time, which will really help you understand what goes in the mind of one of the sharpest investors of our age. The links are available in the description of this video, and once you read them, do let us know your top learnings in the comments box below. If you like this presentation, then do help us spread the good word by sharing it over WhatsApp, Facebook, and Twitter with your friends and connections. Thank you for your time, and we look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.